We are sort of expecting mildly positive gains for the stock market in Europe, just about 4%. But I think, when you take a step back, I mean, we all woke up this morning thinking there's a lockdown in the UK, lots of news around more lockdowns potentially coming in Europe. So obviously there's that feeling that it's a bumpy road, but we continue to believe that investors and certainly corporates are looking ahead through all of this. And the big news is obviously the vaccine and its deployment. And what's really key to a bit more certainty is obviously that deployment, and we think it's happening. So far, so good, and we believe we're likely to see more investment and potentially more growth and some recovery.
And yet, Elise, yesterday when we were down 700 points at our worst on the Dow, I had a kind of a deja vu feeling about this, that we could see some serious violence before the market finds its feet again as well. Do you expect those kind of episodes to test the mettle of your investors and our viewers?
We certainly would, in the sense that obviously valuation is certainly very testing. When you look at the European market, it's currently trading at 19 times 2021. That's against an overall average of 14 times. So that's sort of the limit of the equation, is that obviously we've got testing times valuation wise. But meanwhile, we do have a couple of themes that are quite important and driving equities. You've mentioned M&A, and obviously M&A is definitely something we would expect more of. Europe has lagged the US in terms of more M&A, first of all, but you still have some important cash buffers that companies have built, and they have to put that cash to use. The route to dividend is perhaps less morally acceptable. We also have a number of companies that need to restructure in the face of the big growth changes that they face with the COVID crisis. Some can use that to put to growth, so we expect more M&A. That's one thing. The other thing is obviously in Europe that we're likely to see a redirection of capital towards more ESG. In fact, when you look at investors and we look at funds, we find that funds in Europe have seen a number of withdrawal. But actually that's not the case for ESG. And ESG, we've seen inflows of around 16 billion just last year. That's against outflows, generally speaking. So all of that is likely to drive going forward. But yes, the road is likely to be bumpy, and there'll be volatility in the news.
Elise, if we just look at that rotation into Europe that you're describing for us, to what extent, when you put a currency overlay on that and the prospect of strengthening of the euro, do you then have to get a little smarter about where you want to be in European equities? Could you just walk us through the maths?
Yes, so basically, when you look overall at the European sector, I mean, there are some limits to what we're recommending. I mean, we are, our strategists are overweight value sectors, generally speaking. That would include certainly oil and gas, for example, but that does not include banks. And there's a very good reason for that. We've got a limit for rates, and we've got the play with currency there. I think in terms of generally speaking, where to be in Europe, we would still recommend some growth exposure, and that would include healthcare. That would also include potentially some of the more, again, ESG driven, and we would be looking to do a more thematic and a little bit more of a selective approach within sectors, actually.